Understanding real options, empowering business decisions. In the dynamic landscape of business, where market conditions, economic fluctuations, and technological advancements can significantly influence decision-making, understanding real options becomes paramount for corporate managers. A real option is an economically valuable choice that managers have to make or abandon concerning business projects or investment opportunities. Unlike financial options, which are derivatives linked to financial instruments, real options involve tangible assets such as machinery, land, buildings, and inventory. This article delves deeper into the concept of real options, their valuation, applications, and specific scenarios where they can provide significant advantages. What are real options? Real options give a company's management the discretionary right, without an accompanying obligation, to engage in specific business activities or investments. This flexibility allows managers to make decisions that can adapt to changing economic, technological, or market conditions. Key aspects of real options include non-financial nature. Real options pertain to physical assets rather than financial derivatives, thus referencing substantive investments. Decision-making flexibility. Real options empower managers to choose between various strategic paths, such as expanding, delaying, or ceasing projects based on current or anticipated market conditions. Examples of real options. 1. Expansion options. Companies might invest in infrastructure that allows for future growth, for example, a manufacturing facility that can be scaled up based on demand. 2. Deferral options. A business may choose to postpone an investment until uncertainty is reduced, for instance, waiting for a more stable political climate before entering a new market. 3. Abandonment options. The ability to halt a project if it becomes economically unfeasible, thereby limiting losses. The importance of real options in decision-making. In the realm of valuation, factoring in real options can significantly alter the perceived value of an investment. Traditional valuation methods often overlook the potential benefits afforded by having multiple future options. Thus, utilizing real options value, ROV, analysis can help executives estimate the opportunity costs related to continuing or abandoning projects, leading to more informed decision-making. Real options valuation techniques. Valuing real options can be complex, however, methodologies similar to financial option pricing are often applied. Some common approaches include net present value. NPV often serves as a baseline in evaluating investments. ROV analysis uses NPV as a starting point while adding the potential value of remaining options. Monte Carlo simulations, a statistical approach that uses random sampling to assess risk and estimate potential outcomes for various decisions under uncertainty. Binomial models. These models break down the decision-making process at various points in time to assess the value of options through a series of possible outcomes. Important considerations. Though real options analysis provides significant flexibility and insight, the valuation remains largely subjective. The valuation often relies on managerial intuition and experience, as the true value can significantly depend on external factors and pressures. Special considerations in real options analysis. Heuristic reasoning. Real options analysis might be deemed a heuristic technique, a flexible approach allowing managers to make quick decisions based on sound financial criteria amidst uncertainty. Given that identifying exact valuations of real options can be challenging, this heuristic approach helps navigate complex business scenarios while allowing for some level of estimation based on experience. Appropriate contexts. Real options analysis is especially relevant in volatile economic environments where market conditions are unpredictable. Businesses that maintain flexibility in their corporate strategies and have adequate financial resources to absorb potential downsides are well positioned to leverage real options effectively. Real-world example: McDonald's expansion strategy. Consider McDonald's Corporation, MCD, which operates in over 100 countries. Suppose the company's executives are contemplating the expansion of its restaurant chain into Russia. This decision embodies a real option to expand, with management needing to evaluate initial investments, including land costs, building construction, hiring, and training staff. Market insight, anticipating potential revenue and comparing it against various risks, such as economic or political instability. Deferral option, given that there might be changes in current political scenery, executives may opt to delay their expansion until conditions are more favorable. This scenario exemplifies how real options analysis can allow companies to act prudently without committing to immediate financial outlays amidst uncertainty. Conclusion. Real options represent a powerful strategic tool for business management, providing essential flexibility in decision-making processes. By enabling managers to evaluate projects related to tangible assets in the face of fluctuating market dynamics, real options enhance the capacity to mitigate risks and maximize potential benefits. Incorporating real options analysis into corporate strategy fosters a proactive approach to investment decisions, positioning companies better in an ever-evolving landscape. As businesses navigate the future, harnessing the power of real options can offer competitive advantages and drive sustainable growth.